What's up, everyone? Sorry if I was a couple of minutes late. Let's get started. And if you guys have any questions, as always, just drop them here and we'll take it from there. Yeah. Okay. So today, what we're going to do is look at how we can go about finding multi-baggers from scratch, right? I have a couple of sectors in mind that I could work with. For me, chemicals is the bread and butter. When you look at finding multi-baggers, we have so many examples. We have SRF, we have PI Industries, we have Naveen Fluorine. It's basically like an unlimited number of multi-baggers that you get out of the chemical sector. So I can focus on that. That's my core sector for the next couple of years. They've consolidated for 5 years now. About so if you look at, let's say, the chart of PI Industries, for example, right? You can see that for about the last 5 years, the stock has about been in a range, right? If we look at this peak that happened in September 21, which was 3,500, we're still about 10% below that. So that rarely happens in chemical stocks. If you look at PI Industries and just its chart, we can see something like this happened here, May 2015 till the end of about 2018. We saw the same thing happen, right? The 700 to 700 ka range. Then when it breaks out massively. So then we had a period of some 3 years where it went 4x, right? 5x. Now, similarly here again, for about 5 years, it is consolidated. It might take another 3 months, 6 months. But then when it breaks out, it's going to break out big. And the reason I'd be open to picking up chemical stocks at these prices, and I'm not talking about your SRFs, right? I'm talking about your stocks that have been consolidating, not Naveen Fluorines, because again, they've become popular, right? Because of hydrofluoric acid and how popular that has become with its usage in machinery and manufacturing and solar panels. The fluorine industry is a little bit saturated. But you have PI Industries, for example. You have another one that is Poshak, which is for phosgene, right? Like that's a chemical that needs a lot of approvals to get into. So I think Poshak and Atul, I believe, are the two stocks that work in it. So again, this could be a brilliant company to go into, the ones that have been consolidating. You might have to wait 3 or 6 months, but then when they start picking up, they pick up big. So an SIP 3 to 6 months, and this would be the sector that I primarily would focus on when I'm looking to get to find multi-baggers. But then that depends, right? You could have a different sector that you're interested in. So if there's any particular sector that you want me to work with, all you got to do is just put that in the comments, and then we can work from there. Yeah, if there's any questions, do let me know. I don't think we've had many people join yet, but we'll start with our work. Okay, so if you're looking for multi-baggers within, let's say, the chemical space, the first thing I would want to do is look at which chemicals in India have the fewest suppliers, right? Now, I come up with these 4 or 5 chemicals, right? And I've already done some work on this. So let's say if we're checking hydrofluoric acid, which is the most popular right now, right? We don't really import a lot, but our domestic production matches our needs, our demand about exactly. So if this demand grows, then we can expect the companies that produce hydrofluoric acid domestically to start growing as well. So let's say I look at hydrofluoric acid producers in India, and I'm going to get a few companies, right? Tanfac, Naveen Fluorine, and Gujarat Fluorochemicals. Now, here's the interesting thing. If you look at the stock price of all three, you'll see that they're all trading at near all-time highs, even in this volatile market where mid caps have collapsed. The reason is that hydrofluoric acid and its uses are not going anywhere. So it's used in the petrochemical industry, stainless steel, and glass etching, which also finds its way into the solar industry. So you take all these three, and these are three industries that have a lot of demand. Even if people say that the solar industry is a little bit saturated right now, I agree it is. There's a lot of companies coming up with solar power, but the back-end producers, right? They still have to create that glass. They still have to create those panels. They can't go out of business. So until they go out of business, the demand for hydrofluoric acid from that industry will keep coming in. The same for manufacturing, right? So if you notice, it's also for electronics, semiconductors, that is. And again, pharma, India is obviously one of the biggest pharma producers in the world. And electronics, especially semiconductors, becomes another sector that supports hydrofluoric acid. And that is why we see Tanfac Industries, or if you want to check Naveen Fluorine, all these stocks you'll find at all-time highs because the market is pricing that in already, that this industry is not going anywhere. So if these give me a good drop, for example, for let's say Naveen Fluorine, which is like a multi-bagger, decadal multi-bagger, if I get to 3,000, it's a blind buy. But even if I reach the range of about 4,500, I'll start buying in with, let's say, an averaging down every 10 to 15% in 3 to 4 tranches. Make sure that I manage to buy into a company that does seem to have a very good future. Would I buy right now? No. You can see that earnings are at an all time high, while the P is also higher than average. So many times I see people just checking the average PE. For example, its average P is supposed to be somewhere around what, 23, 24, whereas this is at 60 and you'd say it's expensive. But that's not how it would always work. Pardon me. Sometimes the PE of a stock can look high when the earnings are low. For example, let's say which company would not be making earnings. I'm guessing ABFRL would have bad earnings right now, right? So if I check this company's chart, see, its earnings are really low. But let's say if it was positive, you'd probably see the PE at about 3. For example, Naukri, I remember, had very low PE because of a shoot up in earnings. So if you see here, the PE of Naukri at this point, right, would look like it's at 15, 16, to even 3 at one point of time. It was that low, single digit PE. But the problem was its earnings were high. The earnings were high because they'd sold stake in some of the companies that they had bought into much earlier. Because you should know that Mr. Bikhchandani has a stake in Eternal and many other big companies. So sometimes your earnings could be high that lowers the PE, and sometimes your earnings could be low that shows that the PE is high. For example, Aarti Industries that is struggling right now, another chemical stock, the earnings are deflated, and that is why your P looks like it's 43. But if I look at peak earnings, which I expect the company to come back to, that EPS is 34. Here the EPS stands at about 7.5, 10, right? Let's say 10. So if I 3x the EPS, the P automatically compresses by 3 times. So the 43 PE will immediately come down to 14, and its average P is supposed to be somewhere around 22. So if Aarti Industry makes a recovery and just comes back to its peak earnings, then just in that case, Aarti Industries would be about 33% undervalued. 14 ka P versus 21 ka average P. And that's where I can buy into Aarti Industries. Just knowing that it's possible the company, the moment it gets back to peak earnings, will make higher returns. Just a side note that I wanted to point out. Now, hydrofluoric acid, we can't really go into because the market is already factoring in everything. So we have to wait for a correction. What we could then try is looking into the next one, which is this, right? And once again, what I want to highlight is it's incredibly straightforward. Not easy, but straightforward. So let's say if I look at producers of methyl diphenyl diocyanate, we can also look at its uses so that we understand which industry we'll be going into. So construction, insulation. Now, insulation will be something that will be used in semiconductors a lot, right? Fabs and data centers, more importantly, pardon me. So data centers make cooling and heating are a major issue. You have to keep them at the optimum temperature. So this could play a role. I would role. I'd want to check that out going down. Packaging is a very stable industry. It goes up and down with the economy, but it isn't really going anywhere. And then there's refrigeration, again, something that might play a role with the semiconductor boom. We'll have to check that. Coatings, adhesives, sealants, and elastomers, again, all of these seem to be stable industries, right? The only outlier could be semiconductors. So I'd want to check if this can be used in semiconductors and data centers. So let's see if there is any utilization there. Yeah, so it is used here. So if you can check, one derivative of this chemical is used in data centers. That means there is a high growth industry that this could be used in. And let's say we check the market projection. Now, right now, I'm just using AI to show this. I will back this up. If I'm actually going into the sector, I will back this up with real data, right? I'd like to look at reputed sources because AI sometimes fudges it up. Now, in terms of growth, we're looking at it about going 1.5x in 7 to 8 years, 6% CAGR. That's not brilliant, but it's all right. Maybe we could see if India's import and export could be a difference. So I'd want to check, are we importing this? So it's reduced import duties. Now, why would the government reduce import duties on something? That means they need more of it coming in, right? That means there is high demand. Again, think about it. You reduce import duties on a particular substance or a particular product when you want more of it to come in. Why would you want more of that particular product to come in? Because you need more and you can't domestically produce. If there was excess production, we would never reduce import duties, right? So that means this should find some demand. Now we can go back to who the producers are. Having simply justified it, we'd of course have to go deeper, but we have somehow justified that, yeah, there is some form of demand. Now, as I look at the companies here, one name stands out. I already know of BSF. I think all of us have heard about this. And I'd like to see how big is the revenue from this particular. So 23%, right? About 23% comes from this segment. Industrial solutions. Okay, so this is one stock that can be shortlisted. That there is something within BSF that does come from MDI as a chemical. There's also Vardhaman Chemicals. So here you make a note, right? BSF is something that we want to check. Vardhaman Chemicals doesn't seem to be listed. Okay, let's move to the next chemical then. Let's say we found one. If we're checking imports, because Indianification is one of the biggest things, right? So methanol, caustic soda, acetic acid, and phosphoric acid. We already know that for phosphoric acid, we have a couple of producers. So let's just make a quick check. Oh, so Paradeep Phosphate is one of my favorites. I remember talking about it in 2024. Then I said that this is a company we should buy into. It's given a massive correction. This is nice. I think my buying point was about 1991. So this is a company I would really go into. Now that comes from research I've already done in the past, and I'll just go into explaining exactly how that works. I remember making a video on Paradeep Phosphates in 2023 or early 2024, right? You can find that. It was mentioned in like a bunch of videos where I talked about multibaggers. And as it was going up to 200, 224, I felt bad because I think I had sold it somewhere here between the 140 and 170. I don't remember right now. But I exited this in late 2024. But right now, at these prices, I think this is a blind buy. This could very well be a multi-bagger coming from phosphoric acid. So just to make sure that the industry still survives, let's just see where phosphoric acid is used. And those industries have some room to grow, right? Of course, fertilizers, we're all aware of, it would be used in that. Used in colas, so your Coca-Colas and everything else directly becomes linked to Varun Beverages growth as well. Rusting from metal surfaces, so that means there is a construction component. Water treatment is very important element. Pharmaceuticals and personal care products, right? So I would want to know more about water treatment, right? How important is phosphoric acid for water treatment? Because I know that is a sector that will grow not just because we humans in India will need water, but because the semiconductor industry, the AI industry as a whole, which in one way or another is going to become big, that will need a lot of water. So is phosphoric acid crucial to it or not? That becomes a big question, right? So to prevent corrosion, that's great, but what else do we have? Neutralize alkalinity and reduce pH. Okay. And for wastewater treatment as well. Great. So let's now check if in wastewater treatment, there are alternatives. What I'm trying to do here is see what could break my thesis. I'm going into phosphoric acid, right? I like a company that is focusing on that. Though Paradeep Phosphates is a purely fertilizer-based play, but what I'm doing here is I'm making sure that a stock I'm going into has alternatives, that it doesn't just have to stick to one industry in case that industry suffers, in case something goes wrong with agriculture, in case we go into a massive recession, or if we have a political change. Does the company have a pivot to go into? Because the AI boom, no matter who comes into power, has to stay. Policy could change the focus on rural India or urban consumption, but the AI boom, so we can't get around, right? So I'm just seeing if they have a pivot available or not. This is called. So for me, this is basically coming from a quote that says, smart guys always have a backup plan, right? They always protect themselves. That's what I'm trying to do. Worst case scenario, this company has something to go into and it won't go bust. So yeah, we know that it's used in other sectors as well, and in all the sectors, whether it's wastewater treatment, just removing the alkalinity from water, which means bringing it to the right pH. And I'm sure that for AI usage for data centers, we would need the water to be at the right pH, right? Otherwise, again, corrosion will become an issue, which I'm sure that in an industry, pardon me, that needs to be as specific as data centers, that will be big. So phosphoric acid becomes a thing for me. And I, let's say, shortlisted down to Paradeep Phosphates, which is brilliant because I have read about this company a little bit. So let's see what it really does, right? So fertilizers, main focus. It is led by Zuari Agrochemicals, which is a pretty big company, as in the market caps you see would not be huge, but the promoters are fairly big. They have massive stretches of land under them that they can use for whatever they need to, right? So there's another company called Zuari Agro, I think, that had risen very fast, right? I remember having seen this company somewhere here, and I thought that it's just moving up in this very nice pattern, right? Respects the support of these higher lows and higher highs, which again, it's getting close to. I wouldn't buy into it, Abhi, because this is a slightly dubious company. It has a very long history, but hasn't really done much. As a off bet, maybe, but not really. The point is that the promoters are fairly well established. Now, it is the second largest private sector fertilizer company. Again, brilliant. Now, if you really want to go really deep into this company, then you want to research all of these as well. I don't do that because I know that these products can change, right? The company can pivot from one to the other if they are similar products depending on the need. What I need to know is whether the demand for the overall bracket that this company works on is large enough or not. As long as that stays, we're good. Zenith, just a second. I'll just go through the couple of comments here. I'll just get to that, Zenith, both the companies in 2 minutes. And right, Ghost. So that's what you want to do. If you're going for penny stocks, Ghost Kano, you have to diversify. You have to massively diversify because one company can go bust at any time, and then the allocation has to be really low. If you're managing a big enough portfolio, then what I would do is stick to maybe 0.5% of my portfolio max, and in total to penny stocks, maybe 5% of the portfolio. I wouldn't want to make it larger than that, especially in this period, right? If you were asking me this question in 2020 or 2022, let's say, I'd say go for it. Again, in 2021 mid, again, I would have said no, don't allocate too much to penny stocks. Because you have to identify if you're in a massive bull market or you're in a market that's finding reasons to correct. 2021 was a point where we were reaching the pinnacle of valuations, right? So we were going to correct. That's the time you want to stick to low beta stocks or stay in cash, not penny stocks. But then you come to mid 2022, where you see that, yeah, the worst of the Fed rate hikes has played out. And now we should have another bull run coming in, maybe a year or 2 years. And that's when you go into the high volatility stocks, which includes your penny stocks. So right now, yes, I would say have multiple penny stocks in your portfolio. If you go into penny, make sure you stick to 5% in this period. 1 year from now, maybe 6 months from now, once we see valuation resets happening, once we see the froth disappearing and the light at the end of the tunnel, then we are at the start of another bull run. That's where I would increase my allocation to maybe even 15-20% to really high beta stocks, not purely penny, but really high beta stocks. Okay, now coming back to Paradeep Phosphates, how would I go about evaluating this company, right? If I'm allocating a small portion to it, if I'm allocating, let's say, a percent or 2% to it, the only thing that would matter to me is valuations at the moment, right? The management is stable, the business is stable. So what this tells me that the company is safe enough. Now I want to see I'm not paying too much for it, right? This is the next filter. I know that I'm paying about 10, 12 earnings, and I know this industry is also going to go. So it's a fairly cheap industry. Now, to make sure that the company isn't highly indebted, very important. I can see that they have about 5,600 crores of borrowings. Where do they come from? Mostly from short-term borrowings. That could be good or could be bad, depending. So short-term borrowings could be just for operational capex, right? What I mean is they need a certain amount of funds to produce the goods that they already have orders for, but they're not using internal accruals. They're working on credit, right? So they might have a 90-day, 180-day credit cycle, and they just work on that and they keep the margin. So for example, let's say I get an order for 200 cars, right? Now the 200 cars, to me as a producer, let's say each car is worth $10. It's going to cost me $2,000, right? And then I'm going to sell it at $15. So I'm going to get $3,000. Now, instead of using my own money for that 2,000, I might go to a bank and say, listen, I don't have that much money. Why don't you lend it to me? I have this order and I'll finish it off in, let's say, 6 months. I'll pay you 210. So I'll give you a 5% interest on it for those 6 months. The bank says, yes, I take that money, I use it, I sell it for 300. And instead of earning 100 rupees, I just earn 90. That's one form of short-term borrowing that is good for the company if they maintain their credit cycle. Now, you might ask, how do we find that out? It usually shows up in accounts receivable, right? Like, what do they expect to get back? Because it's a cycle, the loan they have right now will be paid off by what they had delivered 6 months back, right? And that will show in accounts receivable. So that's how you can figure that out. And I wouldn't worry too much about the short-term borrowings. Now, other liabilities, the trade payables of 5,000, that's a little bit bad. Because what that tells me is we might run into some issues unless their accounts receivable are high, trade receivables are higher. So yeah, this balances out exactly what I told you, right? So if you look at the inventory and trade receivables, this trade receivables is what's canceling out your short-term borrowings, and this inventory is what will cash out your trade payables. Do you understand what I mean? This is what they borrowed 6 months back. They're going to pay it back by the accounts receivable, right? What they'll get here, they'll pay it back using this money. And then the inventory is what will, this 4,800 is what will pay back your trade payables. I know you can see that the payables are higher, but those are small margins. Both the company must be working something in the background. All we can see here, because we don't have direct access to the company's CS, all we can make sure is that this short-term borrowings isn't too high, that there is a way to pay it back. So if you remove that, you're left with 800 crores of borrowings, and they have 6,000 crores in reserve. That sounds about right? That's as good as it can be. Now, if you check cash flow, they usually cash flow positive. The only time that they were heavily negative is here. Let's see why. Profit from operations was still good. So receivables was minus 24. So they did not get an earnings, I'm guessing. Still looks like an outlier. I'd want to check that out, but even if I don't find information for that, because it's very difficult to find that, I'm still okay with it, in the sense that it's only happened once, and otherwise the company has managed to stay profitable even at a smaller market cap. So a very basic financial analysis also tells me that the company is doing okay, right? Like, they don't have too much debt, the leverage is under control, the product is good, the management is decent, they come from enough capital behind them. So I can look even deeper. Now, where would I look even deeper? I'd probably go to their website and I'd find their annual report and then check that. Now, I've already done this for Paradeep Phosphates, so I don't want to go into it again. But the key idea being that this is a company I would buy. This is a company that I would, once I've checked through the annual report, now the question is, what would I check in the annual report, right? CapEx, are they going to increase capacity? Where my point is, where is the extra earnings going to come from? Because if they're trading at a 12 ka PE abhi, and I check fertilizer stocks, 12 ka PE is not very cheap. It's not expensive. You can see some trade expensive and whatnot, but 12 is okay for a fertilizer company. It's not cheap, it's not expensive, it's fine, which means I need more earnings to come. So, or earnings kahan se aayenge? That becomes the only question. I've checked that the company is stable, it's doing well, they've managed their business well so far. Now the question becomes, to be a multi-bagger, their earnings must go 5x, right? Where does that come from? Why would a Paradeep Phosphates become bigger than a Chambal Fertilizer or a FACT or a Coromandel International? Because that's where it would be if it's a multi-bagger. So that's what you want to check in the annual report. You'll get clear messaging from the directors. One more check that you can make for this is if the company projects something. Excuse me. If the company says that we're going to grow at 20% annually, let's say they said that in 2022, did they manage to meet those expectations or not? If they've done that historically, then you can trust the annual report. If they haven't, like Keynes, for example, failed to do so, then I wouldn't trust the management commentary. Then it becomes a cutoff for me. Paradeep Phosphates has a good industry, good history. So I would go into this company. Any questions about all that we saw here? Yes, Chirag, I'll just come to that. Okay, let me just start with Zenith's question first. We have Magellanic Cloud. I've never researched this company, so I'll only be able to give you an overview. Have you spelt it right? Could you just check, Zenith? I think there's something Magellanic. Okay, just a sec. There we go. Okay, Kolkata, that's a bit of a red flag for me because I come from a place very close to Kolkata, like I was born and brought up there. And I know that the industries there have been struggling, mainly because of the fight between the central government and the state government. So that's just a pointer there. Well diversified. Okay, so it's in the IT services. My immediate question is how is it going to handle the AI boom, right? Human resources is good. It's seeing an uptick. So this industry is seeing an uptick because companies that fired people like an year and a half back, they're now realizing that it's different now. You can't just randomly fire. You have to skill adjust. So the company reorganizes. So now HR services are seeing a boom. That's a good industry to be in. Seems like a run-of-the-mill IT company. Why do you like this company, if you could tell me, Zenith? What makes it different from, let's say, Coforge or Persistent or an Infosys or an Axelia Solutions? If anyone wants to go into IT, then again, right, AI might just take this industry out as well. But this is a brilliant stock. If it performs the way it has been performing, they primarily work in airlines industry, and they've managed a wonderful look at the dividend rate. This is what excites me about this company, right? An 8% dividend payout, and I think this stock has more to fall, right? My region of buying will be somewhere here, right? About under 1,000. That's where I would buy into this company, about 20% down from here. I have to keep an eye on the AI thing, but with this dividend payout ratio, and I'm not sure if the company is going to adjust well to it or not. But yeah, if I'm looking at an out of the box IT's company, I'd look at Axelia instead of that one. Just a moment. I'm just covering one after the other. Jyoti structures. Please, people, remember, right? Don't blindly follow what I'm doing. I'm just another guy who spent some time in this industry and managed to learn from much wiser people. um, Electricity transmission, distribution, and substation is a good business. See, right now we might see a bit of an upheaval in this industry because the government is trying too many things at the same time. But capex hai and nuclear power is coming in, so we'd have to see how which regions we expect nuclear stations to come in, because I feel like that's going to be part of the future. Humanity as a whole is moving more towards nuclear power and renewable energy than solar power. We've, I think, sort of realized that the intermittency, right? Solar power isn't available 24/7, right? You need BESS systems, right? We've talked about this, battery energy storage systems. You need that as well to manage solar power. And then there's a lot of hassle there. Whereas nuclear power is clean and it can give you much more power for the same amount of fixed investment. When I say fixed investment, I mean the land you use and then the structures you have to build. So we're moving towards that. So what I'd want to check with any power company is how um, well can they integrate into the nuclear ecosystem. But yeah, power transmission company could work. Let me just work this. Right. So EHV, I think there are two, right? There is extreme high voltage is what the government is moving into. Make sure you check that. But this could be pretty good, right? Um, I think I'll just check if it's that. Extra high voltage transmission lines, right? So this is pretty good. If it's a leading manufacturer of extra high voltage transmission lines, that is good, because the government has been saying, and they're investing into this, they're trying to move our transmission from a lower voltage to a higher voltage because the drop off is lower, right? We lose a lot of energy in transmission. EHV mein wo nahi hota hai. So this can be a good deal for Jyoti Structures. I think this might be the reason when you said that you have institutions buying into it, that might have been the reason. Though if I look at the investment pattern, investor pattern, that's not very promising. because we've seen a lot of divergence now, right? We can see that domestic mutual funds have sold off everything. That's never a good sign, because while FIIs will know macros better, your domestic institutional investors know the companies in and outs. So if they are selling, and funds like State Bank of India are selling, unless this was debt led, but even if it was debt led, why do no domestic institutions want anything to do with Jyoti structures if the company is that good? So I'd need some forensic accounting into this. This something's up. I can't tell you what, but something seems to be up. The fact that the company is trading at almost all-time lows, I wouldn't risk my money. I really wouldn't risk my money. But again, I don't know well enough about this company. Okay, coming to Chirag. Just a second. Chirag, I don't know if the market will break all-time highs or not. I think 99% it won't. I don't think that we'll see a comeback from these levels or strong comeback. You might see short coverings. But remember that in the 2000 crisis, in the 2008 crisis, we saw the strongest single day rises, right? During bear markets, when the market is weakest, right? That's when your strongest pullbacks come. So I wouldn't be so sure about. Oh, you guys couldn't see this, could you? Should tell me in the comments. Okay, so let's say we look at the Nifty ka chart. We'll continue from here. Um, During the 2008 crisis, right? So if you look at this region, this is where the crisis had begun, right? In 2007, everyone knew that something was wrong, right? But the market went up quite a lot, right? I think we saw how much of a rally. Even from the 6,000, we saw what, a 6,270. That means a 5%, 4% above the previous peak. So the market can rally to any point. What we need to do is we need to be sure of our thesis. So I'm internally fine with the market going up 10% from here. Like, I haven't put in all my money into short, so I'm ready to wait it out. I don't think it will, but it might just. You have to be ready. It's the market. Zenith, if you're confident about Magellanic crowd, that's how you pronounce it, then go ahead. But I wouldn't buy into it. Urgently don't duplicate stocks already in your mutual fund portfolio. That's very smart to do, Zenith. That's a very smart way to manage it. Right. Ravuri. Satya. Oh, let me just call you Satya, please. Let's look at ASM Technologies, right? We all know what the company does. It's very popular now. So I have a problem with charts like these. First up, like when you see vertical rises, something doesn't add up. That always happens. Though this company, we know the industry it's in, we can understand why that happens, right? So we know, again, R&D. For those who people don't know, this is a massive exposure to the semiconductor ecosystem. So ASM Technologies is one of the only providers of finished high-end or the technology needed to create high-end chips in the world. I think there's one that's ASM, and then there's another in Netherlands, and then there's I don't remember. There's one more. It's 3 companies or 4 companies, I think. It's well diversified, great company. I mean, their business is brilliant. There's no doubt about this. They have great partnerships made and all that, right? So at first glance, if you look at the company as, let's say, um, a business, it's a brilliant business. But my problem is the way the stock's risen and the valuations as well. I mean, a 60 ka PE, that means, very technically put, right? Like in finance, when you learn basic finance or basic valuations, financial markets, what they teach you is PE should be equal to growth rate, or ROC at the very least, return on equity at the very least. That won't happen. It's not going to give you a 60 ka ROC. Like, for example, a company that does this and has done this for ages, which is why I'm bullish on this company, is this. You have a PE and a return on equity balance, Page Industries, right? Especially with the FTA, with the European FTA, this company should do really well. Maybe it'll drop some more. I don't know about that. I don't invest for 1 month, but this is a company that can do really well. Now, as far as ASM is concerned, I would want to buy into this company. I feel like I missed my chance there. I was the loser there, right? Because had I bought into it at these levels, I mean, the returns would have been massive. But am I comfortable buying into it here? I'm not so sure. If the company has a moat, right, like something that nobody else can do, because they don't get the technology, right? They can only, even now, I think their core would still be OSAT. They're not going to do much more than that. So if the technology transfer comes in, if they start building something that another giant in India cannot do, because we have multiple, we have Rajesh Exports coming in with a semiconductor thing, we have Tata coming in with multiple. So if they build a moat, then yeah, then it's a blind buy, especially corrected to what, half from the top, yeah. But I have my doubts if it has a moat. I'd want this thing to play out. I want the crash to play out, and then maybe we can see where we go from there for ASM Technologies. Now, I think I saw Chirag, right, as a whole. Okay, so I think, Chirag, what we've started to see in the market is the small cracks that had been coming in, they're now widening. I'm not saying that the market will crash massively next week. It could, because I had a feeling that we'd see something last week, and we did see a massive blow to the markets last week. IT is a sector, the way it has been falling. If that sector continues to fall, even if the stocks don't, if just the business is hit that way, we know that India's economy goes down for a toss, right? We're still a 60-70% consumer demand economy, right? That's not small. And most of that demand comes from the 1% of people who are in services, and most of those people are in IT. So if IT takes a hit, India takes a massive hit. Our consumption, no matter what tax breaks we get or whatnot, cannot recover. So I think that's the key story to watch for over the next week. How does this thing develop? But from the little bit of reading that I've managed to do, Chirag and everyone else, there are one of two things that can play out from the little understanding that I have. One is AI is as real as everyone is claiming. And that's the more likely scenario, because we have insiders who've quit coming out and saying this. These are not people who have a stake in AI succeeding. These are people who are saying we don't want AI to succeed. Now, if this is a big conspiracy, that is something I can never figure out. I'm not even going to try to. But that seems a more likely scenario, that we now have a GPT 5.4, I think, and you have Anthropic, I think, Codex or something. Both of these are good enough to replace coding, more or less replace it. You might need someone to oversee it, but that's it. Your entry level coding jobs are done. That's where all of our young guns are. My cousins are, my nephews are, right? Like, people who've just graduated from college. Most of our promising part of the population is trying to get an entry level job there. And if they don't have it, what do we end up with? Massive unemployment, because there are no other skills. If you can't be coding, then what will you be doing if you've just finished a computer science ka course, IT ka course? So that's something that I would keep an eye out on. Next week we should get decent amount of clarity there. The second thing is the amount of money that AI has promised over this year, that can keep the US economy looking like it's afloat. And I want to bring your attention to this number that came in the US economic calendar. So this number is about the unemployment, right? I think this was on Feb 13th or something. It was in the last week. So here, right, you see US claiming to get 130,000 jobs, most of which came from health insurance, from the healthcare sector. Your manufacturing added 5,000 jobs. I think finance lost 15,000 jobs. Government jobs were down maybe 20, 30,000. I'm not sure. Government jobs are up 5,000, pardon me. But in general, the trend was downwards. This has been supported by some 55, 60,000 jobs added in healthcare, which is a one time hit, because the president decided to remove your insurance and everything else, and people are now forced to go to hospitals for treatment instead of preventive care. That's what's happening in the US. That's how hollow it has become, which is just astounding to me, right? The US, as great as the country is, that's where it is. So this report, and remember, they always bring revisions for anyone who follows the US economy as well. This should be cut down to some 20,000 jobs. Next month, when they come in with a report, they'll say, oh no, this wasn't 130,000. And that will have another impact on the market, because people are right now believing that the US economy is doing really well. So if we're looking at the markets as a whole, what happened last week and what's going to happen in the next week, I think two trends will dominate, right? One I can predict, the other I'll need an answer to myself. The first is metals ka downfall isn't going anywhere. You might see small rebounds here and there, but I think we've reached that temporary peak at least. Now they have to significantly fall before they make another rise. Then the second is IT. One way or another, we're going to see an answer next week. I think the fall might not exacerbate from here because they've fallen so much. But let's just take a quick look. We'll see that most of them would come close to their supports now. So if you look at Infi, it had a support at what 14.9 about 1400 about. It broke through that, but about 10% down, it has a very strong support, right? It didn't break that even during the Fed rate hiking cycle. So if this breaks, then we're in trouble. There's actually one sign that situation is worse than it might look. That's TCS ka chart, right? It broke its support. It broke its 3000 ka support. I had, in fact, I still have that lot. That's my hedge against my shorts. But I'm long on TCS at about 3000. I'm going to hold it even if it goes down to 1000, 1500. This is a hedge. I'm not saying buy into it. But if IT recovers, I wanted to make sure I have something in my hand. So the fact that TCS broke its support is a very bad sign. It's another giant, right? What I would do to play this is probably if I get a bounce, I'd be shorting these because these are the real overvalued ones. These are the ones that don't really have promise, your Coforge and persistent systems. So these are the two themes, right? Metals and IT. Another sector that I'm very much short on and I'm going to stay short on, this is one of my highest conviction plays, is this, your OMCs, your Hindustan Petroleum, your BPCL, and your IOCs of the world. I'm short on these heavily. I'm short on all three. I think in different folios, but I'm short on all three. The Russian crude oil was the reason they were rising. Full stop. If we don't get Russian crude at a cheap price, these can't keep rising. And we've all but conceded that. Even if we continue to get them now, we won't get them in the same prices because the US is going to create some kind of a tantrum around it. So this is a sector, if any sector, if you ask me what would you short today, because metals have already fallen, I think Nalco, I had said that we should be shorting somewhere here, I think, right? It was at 420, right at the peak. That was lucky. I also went short on Hindustan Zinc. That was about here, I think 600 about, right? 605. I was a little late there. So because they've fallen, I wouldn't initiate a short on these anymore. I want to short a Vedanta, but it's fallen. I want to short Hindustan Copper, but it's fallen. These haven't. They're still very close to the 52 weeks the highs. So if there's any sector as a whole that I want to short, it's OMCs for the entire year, though, right? Not a 1 month, 2 month play. My plays are 6 months, 9 months. Might work out in 2 months, but I'm playing a 9 month game because let's say I look at HPCL, right? I'm just going to show you how my thinking works with these trades. If I, let's say, look at an HPCL 450 ka price and a lot size of what, 2025, that's about a 9 lakh rupee ka lot. And the margin needed for this would be, let's say, 2 lakhs. Tops, right? It won't be that much, but let's say 2 lakhs. So that means for 2 lakh rupees of capital that I put in, I stand to gain up to 9 lakhs. If it goes to zero, it won't. But my prediction in an ideal scenario would be this. This is the base, the 125. Maybe it doesn't come there. I'm not strong enough to hold it till there. I'll probably sell somewhere around 300, 350, let's say. Let's say very conservative. Even at 350, I make $100 per lot. With a 2000 ka lot, that's 2 lakh rupees. So I'm making 100% return on my capital there, right? Of course, these have to be very high conviction plays. I have to hedge. I have to make sure I don't take too much risks. It's a very delicate way to go about trading, which is why I'd recommend that you do a lot of reading, you do a lot of thinking. Again, I'm just another guy. I might fail, right? The market might rise by 20% and I might go bankrupt, but I won't because I've hedged. Now, that hedging is something you have to create. My hedging won't work for you. Remember that. But what I wanted to point out was when I make a 6 month, 9 month play, I'm not targeting a 10% up or down, right? I'm targeting a doubling of my money, a 50, 60% return on my money. For example, Muthoot Finance, I'm still short on. I think I shorted this at 4,000, right? Just about at 4,000, just about at the peak. I'm still short on this. And I'm going to stay short on this. It's very tempting to sell it here. I'm making a decent amount of money, right? $400 on a lot. And if it opens quick, I'll just show you the lot size. I think there's a pretty big lot size. $275 shares. That's a massive lot size for $4,000 a lot where I shorted it, right? 275. So at 275 and 4,000, we have what, 550? Oh my God, that's an 11 lakh a lot. So even if it goes to half, I'm pleasantly surprised. Even if it goes to half, I'm making 5 lakh rupees on a lot on a 2 lakh rupee ka margin. That's the kind of returns I'm chasing. For me, a sell and a buy covering Muthoot Finance would be somewhere here, 2,300, 2,400. That's where I'm targeting. That's $1,500 into 275. You do the math. That's 4 lakh rupees about per lot. Anyway, coming back to where we were. Thank you, Zenith. No, Chirag, it really is not. So if I expand on the Fed report, right? So what the Fed, not just the Federal Reserve, right? When you get data from the US's economy, wherever Bureau of Labor Statistics is usually the one that releases it, what they're giving you is this is how much the economy grew as a whole, and this is how many jobs we added. This is our inflation. Those are the three things we get to see, right? But what is happening in the background is what's more important. So what I would want you to do, if you really want to understand this, right, why I think the US economy is extremely weak right now. It's so dependent on the AI as a pillar that if you take that pillar away, then the US would have degrowth in the last 2 quarters. Massive degrowth, not just small degrowth. I'm talking 2 to 3%. This happens every time. I'm talking, can you still hear me? Perfect. I'm talking about a 2 to 3% degrowth, right? If you take the AI economy out of this US economy as a whole. So how would you find that out? Look at what contributed to the growth, to the jobs and everything else. And you'd find that within the US, two things contributed to the GDP growth. One was investment. Now I'll break the investment down as well, but let's say the second one, right? We have investment, and the second one was healthcare. Now within investment, all the growth came from AI. If you take AI out, US had actually lost investment. So people didn't invest, they pulled out money. If you take AI out, and AI investments, we already know it's the circular thing and everything that you already understand, right? I don't have to elaborate on that. And the second part was your healthcare sector, right? Of which most came from health insurance. And then the second came from actual treatment, right? You need more nurses, you need more doctors, you need more people processing claims. That's because people lost health insurance. When Donald Trump came in and he repealed Obamacare, Medicare, people lost insurance. So now what, they don't have the medicine needed. Let's say someone was diabetic. Now they do not have their insulin shots because an insulin shot is, let's say, $1,000. So what do? They just eat healthy and try to just pray to God that they don't fall sick, but they do. And they end up at the hospital where the charges come in, and that's where the growth comes in. So just dig a little deeper into that report and you'll see the truth for what it is. So, Govardhan, I think Indian textile will still manage to compete, especially your likes of Trident. So, if I'm looking to play the export to the UK and Europe wala theme, my stock would be Trident. I remember spotting this company somewhere here. I told a few guys, and this was my first multi-bagger, right? This was my very first multi-bagger. I remember getting a lot of praise for this, kind of reignited the passion. But this is a company that I would go into if I want to play the textile export theme. They mainly export linen, bed linen, and towels and everything else to hotels. That's their core business. And they focus a lot on the western part of the world. So I would want to go into this. Now, Bangladesh can do it, or Bangladesh could always do it, right? It's not like they've just started building cheaper clothes. They had that before India as well. But there is demand and supply ka balance, right? Most of that is taken away. The kind of cloth that good hotels would need would be different from the majority of the cloth that you might score in produce in a particular place. So yes, that hurts the textile industry a little bit, but I see that as an opportunity in the long term, not immediate, but in the long term. Because abhi if you want to buy anything, it has to be in a phased manner. Right. Anything else that you guys want to talk about? I'm here. Boring businesses which will work best for recent trade deals. So, Preet, my sector is chemicals. I think I've talked about this recently, and I've got a video that is currently being edited. It should be uploaded on Wednesday or Thursday, right? So I would work with chemicals, and there's some companies that just stand out. We have your Ether Industries. You know, if you followed me even a little bit, you know that's like my favorite. But yeah, I wouldn't go into IT. I wouldn't go into metals. Banking, private sector banks, long term still look good. Their valuations are good. They manage their books well. I don't think they've issued as many bad loans as public sector banks. But I would stay leagues away from public sector banks. I think there's underreporting. I see reminiscent memories of 2013 here. I do not think tell me how is it possible? And this guy, Saurabh Mukherjee, gave an interview, and honestly, I think he had let me down a few times in his interviews over the last 2 years, but this time he said something very sensible. Your Bajaj finances of the world are telling you that they see credit pressure. They're increasing their hedges against NPAs, provisions as they call it. But PSU banks say that no, we don't need provisions. Our profits are only increasing. How is that possible? How is it possible that private sector lenders, your Axis banks of the world, your HDFCs of the world, are increasing provisioning, saying that we see credit weakness, and they lend out to the best of the best, right? They're lending out to extremely stable professionals. Whereas your PSU banks, who generally lend out to weaker companies as well, they don't see that. That means one of the two is making an error. Now, who is likely to make an error? Someone coming out and saying, hey, we see some issues with our business, or someone coming out and saying, oh, we see no issues in our business. So PSU banks, I think, are the biggest red flag. And right now I'm researching opportunities to short them as and when possible. I'm not going to increase my risk. So if I manage to come out of a short, if one of these stories plays out, I'll be shorting PSU banks massively. Happiest Minds, I know someone who's on the board of Happiest Mind, not directly, indirectly. And I remember her saying that the company is doing a brilliant job. She said nothing else. She just praised Happiest Minds in front of one of my friends, saying that what a nice company. I think it's doing a great job. So if an insider's got a good view on the company, it should be nice. But I haven't researched it enough to buy into it. And I wouldn't either. Same reason. IT is going through a period where if you're going to buy into anything, there are two plays that you can make, right? One, you stick with the giants who you know will survive. That would be your Infosys of the world, TCS. I think TCS is best suited. That's why I'm long on it, because TCS does the runt work. And if you will need someone to do the runt work, they do it cheap. They hire a bucket load of people. The ones who perform stay, the rest go out, right? They're not concerned with their image or whatnot. They accept themselves for who they are. Infosys doesn't really do that. Infosys is still, pretending to be the big dog and all that. I like the company. I don't mean to put it down. What I'm trying to say is that TCS is very humble in its presentation. So as AI brings in the new form of front work, I think TCS might survive. So that's your first play, right? Sticking with the giants. And your second play then becomes knowing that a company has created something special, like Esconet Tech, right? It created something special. I believe that. I could be wrong. I might lose my investment, might go to half. But there at least there's a belief that there is a reason I'm going into that company. I wouldn't go into a company that's just another consulting firm who says we have good employees and we do a good job. That's my take on it. If you know something about Happiest Minds, then again, your belief matters more than anything else, right? Um, that's nice, Sanit. I mean, Lakshmi Organics, Vinati Organics, Fine Organics, these are all companies that in the long term I think will pay off. Sai Life Sciences, I'm quite interested in. Himadri Speciality is also brilliant. SRF is overvalued. That's my only problem. Like if a stock has outperforms the way it has the rest of the sector, then I find it difficult to go into that company. Now it might just outperform brilliantly. You never know. It might become a 10x. But I find it difficult to go because Warren Buffett calls this a margin of safety now. I don't have a margin of safety in SRF. It might be the best chemical stock for the next 10 years. But without a margin of safety, I wouldn't go into it. Yeah, I've heard great things in it. About Happiest Minds, I've always heard great things. I think Great Place to Work worked with them, and they said it was one of the better managed companies. So I've only ever heard good things. The problem, though, is companies with happy cultures can also fail, right? A happy culture doesn't guarantee victory, it increases the chances. So, would I go into a Happiest Minds? Personally, I would. A small cap company in the IT sector at this point of time is way too risky. And look, if anyone works technicals, you know this is the definition of a bad chart. But maybe at IPO price, worth a shot. And if you know something, then go right ahead. Right? It was created by someone who's really who'd worked at what an MNC and then wanted to create a company that keeps engineers happy and all that. I remember that's their thesis, that they want to make sure that every employee who works for them is happy and content in life. That's a very nice, very noble way to go about. But as an investor, I wouldn't put my money there that easily. Did I miss something? Now, within chemicals, I think we just spoke of Paradeep phosphates as being the one that I would be most interested in. Anything else? I didn't even realize we spent some 50-55 minutes. Chirag, I hope you were happy with that explanation about the overall market. If not, just let me know. I know you've been with me since the very beginning. I appreciate that. Right. Awesome then. Thank you so much, everyone, for joining. It's always amazing to have you guys here. Makes my Sundays. And I look forward to seeing you guys again on the coming Sunday. There's a video coming out tomorrow morning, and there's another one coming out on Wednesday or Thursday, I think. Do watch them. Very important. So, Chirag, US AI stocks are basically redefining what bubble means. Just finishing. Thank you, Zenith, man. I appreciate that. So my issue, right, Chirag, if you look at just the P, this is very interesting again. So if you just look at, let's say, pick an AI stock if you want, right? I'm starting with NVIDIA, but you pick one. Let's say I look at NVIDIA ka P, right? It says 45.27. Let's say we pick up another one. What would you pick? Pick a company if you have one. Let's see the first company that comes up, right? Not NVIDIA, we just saw that. Microsoft, Alphabet, Palantir, right? Palantir, pure play in a way. So the P is at 200. Do you think it's overvalued? Even after having fallen so much. Even if you look at an Alphabet, it's not a pure play AI company. It has so much. But even here, no, you say it's at a 29 ka P, right? For Apple, that's not cheap. Apple is a massive company, right? Like that trading at a 27, 28 ka multiple. Like if Reliance trades at a 28 ka multiple, what do you think we'll call it? Right? It would be called expensive, right? Reliance gave a bad result this year. And we're a developing country even then. So yeah, they are overvalued. And you have to remember that Michael Burry came up with this tweet. I think his ID on Twitter is Cassandra BC, where he comes up with this. And he said that circular investing is one thing. That is something we all know about. His issue was how they've pushed back depreciation. So what they've done is, let's say the company's bought 100 billion worth of data centers, right? Depreciation would say that they have to deduct 5 billion for it every year. I'm giving an example. They don't do that. They're just pushing it forward, saying we'll deduct 5 billion 3 years later, or we'll deduct 15 billion 3 years later. So that 5 billion per year is their extra profit. You take that away, and that's at least a 7 to 10% impact on profitability. That is before we think about circular investing. So the problem, Chirag, isn't that on the surface these companies are expensive. They are. The bigger problem is that even when you look into their books, deeper into the books, you see that they're cooking a few things up. And there's no way around that, because just check the P&L accounts, check the balance sheet, depreciation values are much lower than the capital investment they've shown in. They have to flow in a certain balance, right? That's where the issue stands. I'm not talking about Reliance, right? I'm talking about, let's say, an Apple or a Google. So personally, I do not believe that this is going to stop soon. I think we've reached that point, but again, I can't time the market that well, right? Or I would have been a billionaire by now. Might be now, might be in a month, but plus now I'll just add a little bit, right? You can take this as just an instinctual call, but the Clintons are going to be giving in their testimony to the Senate on 27th of February. And if they're going to say what they're going to say, because they asked for a public testimony, that means that this whole Epstein saga, right, comes to a head. And we've seen this happen before. Whenever um, people of power are threatened, something happens. So I maybe like this is very conspiracy theorist, and I wouldn't base my investments on it. But that is a high risk day. And before that, if we are to be distracted, how would you distract the entire world from the horrific nature of those files? You answer that question, and I think that might just be a trigger. Chalo. So Supreet, most sectors will have a major impact. Some sectors will gain a lot. I'm talking about metals. I'm talking about water treatment. I'm talking about power generation. They will gain a lot. You know who will lose that nobody thinks will lose? Defense. Nobody is focusing on the implications on defense. Like America doesn't build too many fighter jets anymore, if you haven't noticed. Right? They're retiring their fighter jets. Like, they have got these bombers and they've got these drones. You have some dogfighting capability, but did you hear about America coming up with the next gen of fighter jet? They're not. So that's an example, right? You look at most systems, right? They just become integrated with AI. AI does the work. So that's a sector that nobody's talking about. Everyone's talking about IT, but nobody's talking about the sectors that will have peripheral impact. Winners, metals, power generation companies, big winners, and water treatment. So I'm talking about the likes of your EMS and all. Now, this might take time to play out. I'm not saying they'll start rising today. And I know this is a horrible chart, but at a 14 ka PE, yeah, because AI is very water hungry. It needs a lot of water, not just power. So I would want to go into this. And ion exchange, I think, because of the technology it possesses, ion exchange is another one I'd be interested in. So we know who will get hurt, these will gain. Metals, after a decent correction that kind of resembles a crash, I would go into metals as well. Even chemicals, because now I'm not learned enough to know exactly how chemicals will play in, but you don't get lithography that is needed to make semiconductors, and then data centers and how they function, the cooling techniques needed there. You don't get that happening without high entry barrier chemicals being used. So if you can find the right chemicals that work there, for example, we found one today. That was phosphoric acid, very basic application. But yeah, that could be another sector that benefits there. All right. Anything else? Sure. Awesome, guys. This was wonderful. Just as good for me as I hope it was for all of you. You can still drop me questions on just the comment section of this video once it's posted. I wish you guys happy investing, and hopefully the next week is good for all of us. My pleasure, Supreet. See you next time.